We've had a stunner of a post-budget rally, and from there, this, new irritant called the US bond yield has brought about a fair amount of volatility and, of course, inflation concerns, fears of a taper tantrum coming in from the Fed, and our own, markets which are worried about inflation, given the kind of escalation that you've already seen in commodity prices. If someone had to come to you right now and say that for the next 1 year or 2 years, here's a sum of 1 crores, how is it that you're going to allocate it? What's going to be the asset mix?
So yeah, I think depends on investor to investor. It can't be absolutely uniform, but I'll kind of let's take the most representative investor in our firm, a person who's moderately aggressive, for the lack of a better word, and take you through the allocation for that investor. So I think of a crore, around about 60% would be in equities for the long term, 40% would be in fixed income. Of the 40% in fixed income, I think 75% would be in the AAA sovereign bucket, 25% would be in the AA plus, and maybe 5 to 10% in the structured bucket. All of these three things put together would typically end up at a return of around about 7.5%. So this is the boring part of the portfolio, the 40%, which effectively kind of yields 7.5%. The 60% part of the portfolio, which is on the equity side, is kind of broken up into two parts. Nearly 85% of that, which is 50%, essentially goes into listed equities. Around 10%, which is 15%, essentially goes into alternates. If the client has the ability to kind of hold it out for the next 3 to 5 years. On the first 85%, the big elephant in the room is obviously how to allocate that 50 rupees into equities over the next 1 year, given the levels of the market and some of the points you made in terms of interest rates, the elevated levels of the market. So there, we follow a fairly simple scientific method. So if an investor has to allocate 60 rupees into 50 rupees into equity, at all points of time, we typically don't go below 60% of that allocation. So effectively, we would look to reach and invest round about 30 rupees in a systematic way over the next 6 to 12 months. So on the 30 rupees, we will be potentially putting in 2.5 rupees every month for the next 12 months. The remaining 20 rupees, we would be a little more tactical about. And we use two methods of combinations of price to earnings and price to book to be able to estimate whether we want to be invested 60% or 100%. And it's not as if this gives you a clinically right result given the liquidity in the market. But for example, on a PE and a PB basis at around about 13,000, 1,800, 14,000, on a 50 rupee equity portfolio, we would be down to around about 30 rupees invested and sitting on 20 rupees cash. So currently, if you ask me, we would, of the 100, if somebody was to give a crore, around about 40 lakhs would go into debt, 10 to 15 lakhs in a slew of alternates, including private equity, early stage structured credit. Of the remaining 50 lakhs, 30 lakhs would go into cash in an SIP format over the next 6 to 12 months. And for the remaining 20 lakhs, we would wait for the markets to come down below 13,800, 14,000 for us to add progressively to the portfolio.